Okay, so in this video, we're going to be taking a look at the 2022 deferred costing question. So this question came up in the summer after the initial June exam had happened for any people that couldn't sit it in June. Okay, so there was two parts to the question this year. There was a marginal costing question, and then there was a flexible budget question there also. Okay, so we're just going to get stuck in then to the marginal costing bit first. So it says A, Willow Limited manufactures garden furniture. It produces a single product. The company's profit and loss account for the year ended 31st the 12th, 2021, during which 16,000 units were produced and sold, was as follows. Sales, 16,000 units, 3,040,000. Direct labour, 900,000. Direct materials, 300,000. Factory overheads, 600,000. Admin expenses, 400,000. Selling and distribution expenses, 500,000. Total cost there then was 2,700,000, and then a net profit of 340,000. So it says the direct materials, direct labour and 40% of factory overheads are variable costs. So I'm just going to take a note of this. So this is 100% variable, the direct labour. The direct materials are 100% variable. And then 40% of factory overheads are variable costs. So 600,000 multiplied by 40,000, okay, so that's 240,000 would be variable, okay, meaning that 360,000 is fixed. All right. Now it says admin expenses is next. That's 100% fixed. And then it says, apart from a sales commission of 20% per unit, selling and distribution expenses are fixed. So €20 per unit multiplied by 16,000 units is 320,000. So that is variable then, right? So 320,000 is variable because we don't know how many units we might sell. So every unit that is sold, it'll be €20. So if anything changes, that's a variable cost. And then the fixed element then of that is 180,000. Okay, that's fixed. So just remind ourselves that fixed costs stay the same, doesn't matter what the output is. Okay, variable costs, they change. So you can see they change, right? So their costs go up as the output increases. Now this line here represents total costs, because that is the variable plus the fixed cost, because the variable line starts where the fixed line is. Okay, so we have to, every time we do one of these marginal costing questions, we have to do a marginal costing statement first of all. Okay, so a marginal costing statement is, it's going to take us a few minutes, but it will be something that you just have to do, and then you refer back to that when you're doing all of these questions here. Okay, so let's get stuck in. So the marginal costing statement, we will have this layer: sales less variable costs. Okay, and then we list out the variable costs. I think we've got 4 variable costs here. Okay, then that will be equal to the contribution. And then we will take away fixed costs. And then I think we've 3 here, and then that will be equal to the net profit. Now the net profit is going to be the same as here. It's going to be the 340 that we already have. Okay, while we're doing this, we're going to find out the amount that it is per unit as well. So this is going to help us when we're doing all of our questions, okay? So we've got 16,000 units, which just came from over here, and that's 3040000. When I divide 3040000 by 16,000 units, that gives me €190 per unit. Now, my labour, 900,000, that is all variable. My materials, that's all variable. My factory overheads, 240,000 of that is variable. And then my selling and distribution, 320 of that is variable. And now my fixed, my factory overheads, 360,000. My admin, 400,000 is fixed. And then my selling and distribution, we had 180,000 of that was fixed. Okay, I put in one too many zeros there. So that's very easy to happen as well. So make sure you don't make that mistake. So yeah, so we just took all of our figures from here. You know, all of the costs altogether will still add up to 2.7 million, but we just split them up into the different fixed and variable elements. Okay, so when I add 900,000, 300,000, 240, 320, I get 176,000. Okay, when I take the variable costs away, that's going to give me a contribution of 128,000. Okay, now to get the per unit amount, then 176,000, that's 110 euro is the variable cost, okay, per unit. So that's the variable cost per unit. The 190 is the selling price per unit, and then the contribution per unit is 128,000 divided by the 16,000 units. Okay, so that is 80 euro per unit. Now the fixed cost, 360,000, 400,000, 180,000, that is 940,000 altogether. I take that away from my 128,000, and I'm going to get 340,000, which is what I have over here anyway. Okay, now that is your marginal costing statement. Okay, and it's very important to do that at the start of every single one of these questions. It's important also to just double check all of your figures to just make sure that you are right. So I know that these are all okay, so I'm gonna get started. So we're gonna look at the first question here. First question here says, calculate the break-even point and margin of safety in units. Okay, break-even point and margin of safety in units. So number 2, break-even point. The formula for that is fixed costs over contribution per unit. So my fixed costs here, 940,000, and my contribution per unit is there, 80 euro. Okay, so when I put that into my calculator, I get a lovely even number, 11,750 units exactly. Okay, so that is the point at which my costs are all covered. Okay, just to do a very, very, very quick diagram to illustrate what it is. Here's the output in units, here's the costs and the revenues. Here is the fixed cost line. Here is the total cost line, because that's the variable cost and the fixed costs. Okay, then if I was doing my revenue, if I went up from here, this is my total revenue, so that's all my sales and everything. Okay, then this here, this is my break-even point. It's the point at which all costs are covered by the revenue. Okay, so that's the break-even point. Now, this is my margin of safety. This is my estimated amount of units, money that I'll be making from the sales. Okay, it's how much my sales can drop before I'll start making a loss. So my margin of safety formula is sales minus break-even point. So that is 16,000 units sales, which is up here, okay, minus my break-even, which is just here. And that gives me 4,250 units. So my sales can drop by 4,250 units before I will start making a loss. Okay, so that is that part done. Okay, so now we're going to get started in the next couple of bits. So you can see here we've got our what if questions. So We'll move on to part 2. So calculate the profit the company would make if it reduced its selling price by 10%, increased advertising by 100,000 and increased the sales volume by 10%, with all other cost levels and percentages remaining unchanged. Okay, so what we're going to do, we're going to be looking at the marginal costing statement that we already have prepared, okay? And we'll just take another read of this question. So calculate the profit the company would make if it reduced its selling price by 10%, increased advertising by 100,000 and increased the sales volume by 10%, with all other cost levels and percentages remaining unchanged. Okay, so the first thing that we have to do here, I would write out the formula. Sales less variable costs less fixed costs is equal to profit. Okay, so sales less variable costs less fixed costs is equal to profit. So we can see here that we don't know what the profit is, okay? So we're going to make the profit equal to X. So that's what we're trying to find out. Now, it wants to reduce its selling price by 10%. So I'm just going to write any changes up the top. So the selling price is €190 that we have up here, multiplied by just 90%, okay? So that will be €171. Okay, now the number of units sold will be increased by 10%. Okay, so that means the number of units sold is 16,000 multiplied by 110%, which is 17,600 units. Okay, so that's how the sales have changed. Now the variable costs are going to change because the number of units is now 17,600 and not the 16,000 that it was. But the variable cost doesn't change because it's still €110 per unit. It was €20 commission per unit. So that is €20 set price per unit, but we just multiply it by the number of units now. And so that's €110. Okay. And then the fixed cost, let's see, did the fixed cost change? So it says it increased advertising by 100,000. That would increase the fixed cost. So the fixed cost would go 940,000 plus 100,000. Okay, so that's going to be minus 1,040,000. Okay, so we will multiply all of this out then. So you're going to have 17,600 multiplied by €171 minus 17,600 multiplied by 110, and then minus 1,040,000, and that is going to be our profit. Okay, so when we multiply the 17,600 by 171, we get 3,009,600. When we multiply the variable cost of 17,600 by 110, we get 1,936,000, then minus 1,040,000. That is then 33,600, and that is the answer to your question. That is the profit that the company would make if it reduced its selling price by 10%, if it increased advertising by 100,000 and increased the sales volume by 10%, with all other cost levels and percentages remaining unchanged. So we always go back to our marginal costing statement that we did when we attempt each one of these what if scenarios. So we're going to move on to scenario number 3 then. So it says calculate the selling price. Okay, so calculate the selling price that they would earn. Okay, that would earn current profits from the sales if the firm had to operate at 50% capacity and all other costs remaining unchanged. Sorry, I have to read this twice because this is confusing sentences. Okay, so just make sure when you read something that's confusing that you digest it completely. So read it twice, 3 times if you have to. calculate the selling price that would earn current profits. Okay, so current profits are 340,000. Okay, from the sales if the farm had to operate at 50% capacity and all other costs remaining unchanged. So 16,000 units is 100% capacity. Okay, so 50% then would be 8,000 units. Okay, so look, we'll use the same formula as always. Sales less variable costs less fixed costs is equal to profit. Okay, now we know that the profit is going to be 340,000. Okay, we know that the fixed costs are going to stay the same, 940, so no change there. The selling price we don't know, so we'll make that X. The number of units has changed, it's 8,000 units. Okay, the variable costs, there's no change to the variable costs. Okay, so no change to the variable cost, 8,000 multiplied by €110 variable cost. So we'll just multiply all of this out then. So we've got 8,000 X minus 8,000 multiplied by 110 is 880,000 minus 940,000, and that is equal to 340,000. So 8,000x is equal to 340,000, and then we'll bring these two figures over to the opposite side, and so we'll change signs. So add 880,000, add 940,000. So 8,000x is equal to 340,000 plus 880,000 plus 940,000. That is 2,160,000. So 8,000x is equal to that. X is equal to €270, and that is our answer. So the selling price would have to be €270 if they could only do half of the units, but they wanted the same profit. So that's what marginal costing is. It is all of these what if scenarios. What if we could change this to what would the profit be if? What would the selling price have to be if we did this, if we did this, if we did this? So it's a lot of what if scenarios. So look, we've got 1, 2 and 3 done now. Now, the theory part of this is for what purpose is the contribution sales ratio regularly used? Okay, so the contribution sales ratio is just another formula, okay, to calculate the break even, and it's when some figures aren't available to us, right? So it is used to calculate the break even point. When necessary, figures are not available, such as variable cost or selling price or units. Okay, so that's what the contribution sales ratio is used for. Okay, now we can move on to part B of the question. So let's take a read. So mixed costs can be separated into their fixed and variable parts by using records from previous periods. Hazel Limited manufactures a component for the pharmaceutical industry. The following flexible budgets have already been prepared for 55%, 75% and 90% of the plant's capacity. So first part of this is asking us to separate production overheads into fixed and variable elements. So they're asking us to separate production overheads into fixed and variable elements. So just a quick recap on the different types of costs, okay? So remember, you've got your fixed costs, you've got your variable costs, but you also have mixed costs, okay? And for us to separate mixed costs, we're going to use the high-low method, okay? So if we were to figure out, this is already a mixed cost, right? But just looking at the admin overheads here, we can see that that is a fixed cost because it is the same. It doesn't matter what the output is. Okay, so it doesn't matter whether it's 27,500, 37,500 or 45,000 units. The cost is remaining the same. Okay, now if we look at direct materials, if we divide 27,500 into 169,125, if we divide 37.5 into 230,625 and 276,760 into 45, we will get €6.15 per unit there. Okay, and if we do the same with direct wages, okay, divide them by the figures there, we will get €8.50 per unit. But if we were to do the same thing with production overheads, 135,750 divided by 27,500, and then if we did the 180,750 by the 37,500, and then the 214,500 by the 45,000, we would get completely crazy figures, and that's how we know that they are mixed. And also we know that they're mixed because the question has asked us to separate them into fixed and variable. But anyway, these two are mixed, so we need to find the variable cost and the fixed costs for each of those. Okay, so we'll find them now using the high-low method. So we will get started. So the high-low method, very lovely, very easy method. Okay, high minus low is equal to the difference. Now they haven't said to show the workings here. Some questions might say show your workings. It doesn't say this here, but I'm going to do the workings out just so that you will know how it's to be done. But you could do it in your calculator, no bother. If it doesn't say to show your workings, don't bother, okay, because you will save yourself some time. So the high number of units is 45,000 units. The low number of units is 27.5. Okay, that gives us 17,500 is the difference in the units. The high euros, 214,500. The low units, 135,750. The difference then in the cost, 78,750. So therefore, the variable cost per unit is 78,750 divided by 17,500. That is €4.50 is the variable cost per unit. Now to find the fixed cost then, if we have the total costs here, these are the total costs, but now we know that the variable cost is €4.50, we should be able to find what the fixed costs are if we take all of the variable costs away. So we'll look at 27,500 units, we'll look at 37,500 units, and we'll look at 45,000 units. So total costs, we're going to have 135,750, we're going to have 180,750, and we're going to have 214,500. Okay, so that's the total cost there for the production overheads. Then if we take away the variable costs, so we know that the variable cost per unit is €4.50. If we can multiply 27,000 units by €4.50, we're going to get 123,750. If we multiply 37,500 by 450, we're going to get 168,750. And if we multiply 45,000 by €4.50, we get 202,500. That is going to give us fixed cost then 12,000. Okay, so that is how to get the variable and the fixed. So production overheads €4.50, and then 12,000 is the fixed. Okay, for production overheads. Okay, the next part then is asking us to get that for other overheads. Okay, so separate other overheads into the fixed and variable elements. So other overheads. So we're going to do the exact same thing. We're going to look at the high-low method for that as well. Okay, so we have high minus low is equal to the difference. So the units are the exact same, but I'll just write it out again. The high is 45, the low is 27. Okay, it's just high 45, low 27. Again, 17,500 units. Then the euros, the high 179, the low 112. And that gives me the difference of 66,500 euro. So if I divide 66,500 euro by 17,500 units, I'm going to get that the variable cost per unit is €3.80. Because the fix is going to stay fixed the whole way across, so any difference has to be variable. Okay, what I'm going to do now, I'm going to do the exact same thing to find the fixed costs. So we'll look at 27,500 units, we'll look at 37,500 units, and we'll look at 45,000 units, okay? We'll take the total costs. So we've got 112,500, we've got 150,500, and we've got 179,000. We'll minus the variable cost, which is €3.80 per unit. So we'll multiply 27.5 by €3.80, that is 104,500. We'll multiply 37,500 by €3.80, that's 142,500. And we'll multiply 45,000 by €3.80, and that is 171,000. If we take all of them away, we will find then that will give us a fixed cost across the board of 8,000. Okay, so that is giving us variable cost per unit 380 and fixed 8,000. So variable 380 and fixed 8,000. So that is how we do that using the high-low method. Okay, so we've done part 1 and part 2 there. Now again, remember, they didn't say to show your workings, and this is your workings here. So if they don't say to show your workings, don't do it, because it's going to take you a hell of a long time to do it, right? So I wouldn't bother if you don't have to. Okay, so the next thing the question is asking us to do is prepare a flexible budget, okay, for 95% activity level using marginal costing principles, and show the contribution. So 95% activity level and show the contribution. So remember that marginal costing statement. What does a marginal costing statement look like? Well, a marginal costing statement looks like sales less variable costs. Okay, so we've got direct materials, direct wages, production, and others. So there's 4 different ones there. That will be equal to contribution. Then less fixed costs. So we've got 1, 2, 3 fixed costs, and that would be equal to net profit. Okay. So you have, you've got direct materials, wages, production overheads, you've got other overheads, then the fixed costs, you've got your production overhead, so that was 12,000. You've got your other overhead, that was 8,000. That was from what we worked out in the high-low, and then you've got your admin, which is 28,300. Now, the materials, how do I know what to multiply this by, right? Well, we did work out the amount per unit, okay? But they're after asking us to do this for 95% activity level. So 95% activity level. If I just take 27.5, divide that by 55, which we have here, and then multiply that by 95%, okay? So multiply by 95, we're going to get then that is 47,500 units. So they want 47,500 units. So 47,500 units is what they want in this this particular flexible budget. So what we'll do with the 47.5, we will multiply it by the €6.15 for the materials. We'll multiply it by the €8.50 for the wages. We'll multiply it by the €4.50 for the production overheads. And we'll multiply it by €3.80 for the other overheads. So if we multiply all them out, 47.5 by 615 is 292,125. Wages, 47.5 multiplied by 850 is 403,750. Production overheads, 47.5 by 450, 213,750. And then other overheads, 47.5 by €3.80, 180,500. Okay, add all them up, 109,125. Add all the fixed overheads up, 48,300. Okay, so I need to say to myself, right, how the hell am I going to get my sales? How am I going to get my contribution? Because they've asked me to show my contribution, but I don't know how I'm going to do it yet, right? So looking back at the question, you know, you might hopefully spot that it says profit is budgeted to be 20% of sales, okay? So profit is 20% of sales. Sales would be 100%, and therefore the cost would be 80%, right? So if sales is 100, cost would be 80, leaving profit at 20. So costs are 80, right? So that's 109,125 and 48,300, okay? So your costs altogether then 1,138,425, which is 80%. If we divide that by 80 and multiply it by 100, we will get 1,423,031.20. Then we take the 109,125 away from that, and we get 332,906.20. Then we take away 48,300 from that, and we get 284,606.20. And that is how we do the marginal costing statement. So they asked you to do it at 95% activity level. So you worked out that was 47,500 units. You multiply it by the variable cost per unit for each of the variable costs. You worked out the fixed costs. And yeah, you just follow it through like that. But the most important thing to remember here is profit is budgeted to be 20% of sales. Okay. And so that is then part B done, and it is that 2022 deferred question complete.